Private equity is a way for investors to put money directly into companies that are not listed on a public stock exchange. Unlike public companies, which trade on the open market, private equity focuses on businesses that are privately held. These investments are generally illiquid, meaning your money is tied up for a decade or more while the company works to improve. The process involves pooling capital, acquiring control or influence, fixing business operations, and eventually exiting the investment for a return. The biggest difference is accessibility and liquidity. Public stocks move every second, while private equity requires patience and long-term commitment. Private equity managers typically charge a fee for managing the money plus a cut of the profits if the investment succeeds. Because of the risks and high minimum investments, this asset class is usually reserved for large institutions and wealthy individuals. Private equity is a complex corner of finance. Always do your research before exploring new asset classes. See you next time.